Hey, welcome back. We are going to talk about scaling responsibly. One of the things that we run into is, should you scale in a coming downturn? Absolutely. You have to scale responsibly. We're going to talk about that right after this. Welcome. We're back here with our take two, or question 2.0 with Hunter Bick and Elevate Capital. We're going to talk about scaling responsibly. Sorry, guys. I'm actually out of town right now, so I'm a little sluggish. Let's get started off with a little bit of housekeeping. Thank you so much for joining us on the Real Estate Investor Channel. Hard money for real estate investors. We are Carolina Capital, private lenders in the Southeast for real estate professionals. If you have a project you want us to take a look at, go to carolinahardmoney.com and click on the Apply Now tab. If you are a accredited investor and you're looking for passive returns, click on the Accredited Investor tab. Don't forget to like, share, subscribe, hit the bell, and don't forget about Wednesdays with Wendy. Oh, wow, that was quick.
That was a nice one.
Yeah. Wendy, gives 30 minutes of her time per person on Wednesday afternoons to talk about real estate. There's the link. It will be in the chat side to the right side of the page, or underneath, depending on the platform you're viewing us from.
You good there? Man, you got it all out. It's all right.
There's a lot of lunch.
It's all right. But yeah, no, Wednesday with Wendy is a great thing. If you want to join on the calendar link, you can do that. You will get something from it, I guarantee you.
Yep.
She has a lot of experience, and she will tell you she's made a lot of mistakes, so learn from her mistakes.
And before we get started, I wanted to mention the Quest Expo was awesome. If you guys didn't get a chance to go, I think you can still purchase the videos from all the speakers that were there. It was an excellent event. I think there were over almost 900 people.
I think 857.
Yeah. Okay. Well, that's close enough to 9.
Yeah.
Thanks for being so exact.
It's my job.
It's his job. Yeah.
But there was great information. Excuse me. If you have a self-directed IRA, or if you don't know what a self-directed IRA is, then there's plenty of education for that. If you want to go to questtrust.com, all the information is free. So check it out.
Excellent. So we want to talk about scaling responsibly.
Yes.
And what the heck does that even mean?
Well, it means getting either bigger or okay, I promise I wouldn't say this, but it's about cleaning your fish. No?
Dad joke.
Yeah.
But no, so we have Hunter on here with Elevate Capital. And since February of 2018, him and his partners have been investing into multifamily in primarily North Carolina.
Well, actually, all North Carolina.
All of North Carolina.
Actually.
Okay.
We looked elsewhere, but
yeah, you like North Carolina. So they have went from 0 doors to several hundred in that time frame.
500-ish.
500-ish. It was more, but you just sold 120, didn't you?
We did.
Yeah. So they were over 600. So they have scaled in that time period from February of 2018 to now on several hundred doors, and kind of want to just pick your brain on what was your thought process, like, when you were looking at this, what, like, did it feel too much, too little, or kind of how did you look at adding to your portfolio?
Yeah, that's a good question. We've always kind of taken the approach where if this deal makes a lot of sense and we think the upside is large, it's our job to figure out how to get it done.
Mm-hmm.
Sometimes that meant buying 4 things at once. Like, there was a day we actually closed 200 doors in one day.
Wow.
There are other times where maybe we go several months without putting anything under contract. but we knew the value is the value, and we were always really confident when we thought we had a really great deal under contract. We had to figure it out. Our approach has typically been, we found so many great deals off market that our approach has typically been, how do we keep as much equity as possible? And that often meant hard money, maybe a debt stack, maybe some investor capital, whatever it was that we needed, we were going to do it. But the first choice was always keep all the equity with high leverage, because we knew we were going to add the value so quickly that we could refinance into permanent debt in 6 to 18 months, depending on the deal. And so the higher leverage was not, for us, was not risky or not scary, because we knew it was going to be very short term, and we knew the value was going to be there. And so that's how we've done a lot of our deals. You get to a certain size, and you see more opportunities. And so we are kind of getting to the point where we're going to be taking more passive investor capital to do some more deals. We do think we're going to see some really good opportunities here in the next 12, 18 months.
I agree.
We're getting positioned for that. And create a little more, a predictable type of, capital process. And with higher interest rates, it's a little trickier these days to count on low interest on a perm loan 12 months from now.
Which is more reason why
Yeah.
you win when you purchase it, right?
Absolutely.
Yeah.
Absolutely. And so obviously the lower the basis, the more money you're going to make. And it really is that simple.
Yeah. I wanted to go back. You mentioned debt stack. So for everyone that doesn't know what debt stack is, you have your primary, like first lien position loan, which would be, just your what you would normally get. And then on top of that, you can get mezzanine debt, which can be secured by a second lien, or it can be unsecured. And then on top of that, you can give up, you have equity, and then there's multiple levels of equity that you can give up. And it just gets, higher and higher. So that's what a debt stack is.
I call that a wallet full of credit cards. That's my debt stack.
Well, and that's how a lot of
used
people,
a lot of those on the way too.
That's how a lot of people do this. I mean, like when you're buying $5, $10, $20 million properties, like no one's really using their own money to do that typically. Now they might use some of their money, but typically people don't have $5 million to just say, hey, let me put it here. And because that, even if they have $5 million, you wouldn't do that. So you want to stack your debt with, mezzanine or, whatever the case may be. As Hunter said, like their whole goal has been to try to avoid giving up equity. And, why? Well, that's allowed them to capitalize on the back end, on the exit at a higher return, which then, like he said in the previous show, he took the earnings from Applewood and 1031 them into another project. So it allowed them to buy more assets. It allowed them to scale.
And as markets change, we are in a higher rate environment, as well as an environment where credit's going to be a little tighter for the institutional type lenders. So you have to take on a few more equity partners in order to get these same deals done, because the fact that they're going to be a little tighter on the credit means that they're going to lend less money on it.
Yep.
If you do go the mezzanine route with a larger gap or a larger percentage of that, those rates are typically a lot higher.
Correct.
You're almost better off having an equity partner to fill in that gap than the mezzanine financing. Am I correct?
Well, it depends on a couple. I would agree or disagree, depending, right?
Every deal is different.
Absolutely.
Every situation is different.
Absolutely. How long do you need the mezz debt, right? Yeah. Or if it's a longer term construction project on a bigger asset, and your options are take some equity partners versus load it up with 10% debt, but it's an 18-month project, that 10% debt's gonna be expensive for 18 months, right? And
so how long can you negative carry?
Exactly.
Yeah.
And so you gotta factor the negative carry in and all of that. And so equity partnerships become less risk. If something goes wrong, you can bring others in to profit along with you. It's important to align incentives at all points, by the way.
Yep.
That's a huge thing for us. But yeah, so the other thing too, to your point, Bill, in today's debt markets, even a year ago, 9 months ago, you could get bridge debt for in the fives, 5.25, 5.5 for 80% of the purchase and 100% of the construction. Today, that quote is 75% of the purchase, 75% of the construction, and it starts with a 9.
Right.
Like it might be 9.5. So different types of debt are appropriate depending on the market. Hard money at what, 11, 12? Where are you guys right now?
Yeah,
Something like that?
between 10 and 12. Yeah.
Okay. Hard money is now all of a sudden really, really cheap because there's no alternative. Well, if you're going to go 75% on bridge at 9.5, why would you not go 100 at 11? Like that's a no-brainer, right?
Mm-hmm.
And so, not to mention you don't have the bridge debt org structure and all the crap that comes with it.
Yeah.
So, that's that's a tool that has become more attractive right now for sure.
Well, yeah, when you break it down, I mean, someone is going to do 75 and 75. So 75 of the purchase, 75 of the reno. That means you have to bring 25% of the costs of the total cost. So typically, you're not going to have that. You're going to have to either get mezzanine debt or equity, and typically you're going to give up equity. And what is that equity going to cost you? So when you're factoring this, you're factoring, okay, I'm paying 9 for 75% of the cost, and then this equity is going to cost me X amount. And if you can get 95 or 90% loan to cost on hard money or private lending at 12 or 10 or whatever the case may be, when you run those side by side, a lot of times the private lending is the cheaper option in the long run. But again, it comes down to the carry. Can you, is there a negative carry? Is there a lease up period? Do you have to get out all the units, flushed out and then reno them all? Can you reno them as you go? So each one is different, but I will say it, debt is always cheaper than equity.
Well, yes, I totally agree with that. That's what we talk to people about that all the time. Why do you get a money partner who's going to take half of your equity when you can get a hard money loan and spend, $5-10 grand worst case scenario on your financing on a home?
Yeah.
Scaling, you have to have good systems and processes in place. Do you want to
Absolutely
talk about any how you guys are doing it?
Sure. So I mean, for us, everything starts with a good buy, right? And so we probably model 100 deals for every 1 or 2 that we buy. I mean, we're super, and everything's off market too. So it's not like we're, modeling deals that are on LoopNet or publicly listed. Like we don't bother.
Except that first one.
Well, yes, except that first one. But so it has to start there. And like, you just have to you have to stick to your guns and you have to be super selective because it's very easy to like go through your spreadsheet model and say, okay, well, I think I can get this reno done for 10% less. And oh yeah, I think I can get 10% better on my takeout loan or a little bit better leverage. And before you know it, you've just, inched your way, you talked yourself into doing a deal that maybe you shouldn't be doing.
You've modeled a unicorn situation that probably won't happen.
Exactly.
Yeah.
So I always try to say, I mean, everything to me is a probability again, so what's a range of probabilities for each piece of the process? What's the average? What's the worst case? What's the best case?
Mm-hmm.
And if, kind of that between average and worst case, if something like that still works, then it's going to be a great deal. If things can go wrong and you still make money, it's going to be a really good deal.
Do you, when you're modeling this, do you stress test them at higher cap rates on the exit? Do you, like, let's say Charlotte's trading on a B level asset at, I don't know, a 6 cap.
Mm-hmm.
Do you stress test them at a different cap rate, or kind of what do you do to stress test those models?
Yeah. So the way we kind of look at it, we're less worried about the cap rate because the end result, because we're not doing A, new construction, right?
Mm-hmm.
We're doing B and C value add. And so on the takeout, if it's a sell, the NOI is really what's going to matter, right? That's going to drive it. And sure, if we have to have a 5 cap on the finished NOI in order to make any money, like no, right? Like I mean, come on. But so if we're going to make money at selling it at a 7, it's probably a great deal, right?
Yeah.
For us, we always want to see what can we refinance it at? Can we do a cash out, or would a refi require cash in?
Mm-hmm.
That's what we never want to do. You always want to cash out or cash neutral, worst case for us.
Mm-hmm.
But the cap rate's not the constraining factor there. The cash flow is, especially in a low cap rate market like Charlotte.
Right.
So, so yeah, we definitely look at different exit scenarios. Like what happens if if the expenses are actually higher than we're projecting? What does that do to each scenario? But we always want to have multiple exits. We don't want to be locked into one path.
Yeah. And we, for the people out there, if you're working with syndicators or other people who are doing this, that's what you want to be savvy about, is understanding the net operating income, understanding that there's a difference between the acquisition capitalization rate and the operating capitalization rate and the exit capitalization rate.
Yeah, let me talk about that real quick.
Yeah, go
so
for it.
The acquisition cap rate is, I think, a huge misnomer, right? That matters a lot if you're buying a stabilized asset. Like if you're buying an A and you're buying this thing for the cash flow, and you're buying it for, market appreciation, call it. The going in cap rate does matter.
Mm-hmm.
Anything else like value add, the cap rate means nothing, because the whole point is you're buying something that's already distressed.
Yeah.
So we bought zero caps, like an empty property is a zero cap, right?
Yeah.
We bought one caps because the financials were so bad.
Right.
Yeah.
That means nothing, because all we care about is what's the cap rate after we renovate, stabilize, improve the operations.
Yeah.
What's that cap rate? Because that's what matters.
Yeah.
All in on cost.
So those of you in the single family fix and flip business, it's basically what's the place going to be worth after the repairs?
Same thing.
You're not buying a property because it's valued at what it's the sales price is. That's not why you're doing it.
Yeah. Yeah. And, just to beat the dead horse here, I mean, we've Hunter and I've had, I don't know how many hours of conversations about cap rates, but
I got a feeling there were adult beverages involved.
Maybe on some of them,
Usually.
yeah. Yeah. But it's like, people don't understand, like, what's the most important are two things. And excluding if you're buying like an A-level asset, which, like that's not what we're talking about here.
Mm-hmm.
It is your operational cap rate. What is your yield? What is your cash flow? And then what multiple can you sell that asset for? Those are the only things that matter. Not, it's like, well, I can't buy it. It's a 4 cap. It's like, that doesn't matter. I mean, if you're going to be putting in $600,000 and raising the rents $200 per unit, 4 cap doesn't matter.
Exactly.
No.
Exactly. And that's the key thing a lot of people get tripped up on.
Mm-hmm.
Now, as Jonathan was saying, if you're involved in a syndication, you're a passive investor in the syndication. What is it you would like more? The sale of the property and get a big chunk of change at the end, or a refinance at the end of the out and you get a big chunk of change? What's more beneficial?
Depends on where you are.
To the investor.
Well, it depends on what you are. So if you,
How good was the buy?
yeah, how good was the buy? Like, am I willing to pay the capital gains on the sale if the buy was good, or would I rather take the no capital gains on a refinance cash out? So it depends.
That was my point. If you get the same amount of money on either end, and
Yeah.
if it's a refinance, it's tax free.
Yeah. So yeah, that is true. So if you are an equity member on this property, that refinances, that is a cash or a tax-free transaction that you
Right.
get. But again, as Hunter, pointed out, as someone who does this, what am I selling it for? What did I buy it for?
Right.
I might not mind to pay the taxes if it's.
At the same time, if you're getting a capital gain during the process, you probably also have some passive losses that you can also add back to that.
Mm-hmm, exactly.
And the cash out refi for us, I mean, that's how that's along with, high leverage on great deals. The cash out refi is how we got here. I mean, the cash out refi is the best thing ever. It's non-taxable. You get all this cash back as long as the property can support the new debt. And if it can't, then you haven't done your job.
Right.
Yeah.
But it's tax-free dollars to go do more deals. And I don't know how many great cash outs we're going to see for the next 18 months, but thankfully we got most of them done prior to now.
Not on the ones that bought them, 2 years and less ago. I mean, that's going to be tough.
I don't think the cash out's going to be the issue. Will it support the new loan?
Yeah, well,
I mean, the cash out still exists.
Yeah.
It's just not going to be as good.
Yeah, the debt service coverage ratio is going to be a big issue for, and that's just how much does the property make, and then how much does it spend on interest, principal, taxes, insurance, and any HOA fees.
But it's not the end of the world either. Cycles, are just that. They're cycles.
Would you say that
Lower-
cycles are cyclical?
Yes.
Okay.
The lower rates will come back around at some point.
Yeah. Yeah. I mean,
Oh yeah.
I mean, like I said, talking with different people, I mean, there are some people who think that,
It's all over.
it's all over, and for the next 20 years, it's just going to be, a bloodbath. And then there's some people who think, oh, January of next year, fresh start, we're going to be great. And, I think neither one of those are right. I think we're between those two. Where exactly, that's the question. But yeah, I mean, when we talk about scaling, like right now, in the next 18 months, are you excited about scaling, or are you nervous? What's your thought process for the next 18 months?
We're always excited.
Yeah.
I think for different reasons, depending on, what the market gives you. I mean, you have to be able to adapt to what the market gives you, right?
Mm-hmm.
No one's smarter than the market, and I don't try to pretend that I am, but I do try to be prepared for different eventualities. And so, right now it's harder. Debt is more expensive.
Mm-hmm.
It's harder to get that huge cash out after the value add period.
Yep.
Okay, no problem. So the move there is probably more equity, a little less debt on the buy, simply because you don't know when you're going to be able to get to 4% perm debt again.
Yep.
That could be a while. So bringing in equity investors to participate is a good way to handle that. Sticking to our guns on good buys is more important than ever.
Yep.
And maximizing the value of the properties you do have. I mean, we're still in an 11% rent increase
Charlotte.
environment.
Yeah.
In Charlotte, and even Fayetteville's seeing huge ones. So as owners of multifamily real estate, that for properties that are already in low interest debt, that is going to benefit us. If more cash flow from those, it allows you more, buffer. You can deploy that toward new deals. You just have to, you can't assume that what you did before is going to work forever in any business.
Yep.
Especially this one, but you just adapt.
The dumbest sentence in the English language is "That's how we always have done it." Isn't? I think.
Oh, it's terrible.
Yeah.
Like, you just have to be realistic about
what we talk about pivoting.
Yeah.
You have to be able to be nimble and pivot. I mean, so to back up on the equity piece that Hunter was talking about, why is that so beneficial, and how can that help you scale? Well, equity, true equity, if you're giving up equity as like an LP, which is a limited partnership. So you have the general partner, and then you have a limited partner. When people invest into multifamily as an equity member, they become a limited partner, and the general partner is the operator. Would be Hunter in this case. How does that help you scale? Well, the debt is a fixed monthly or quarterly or however it's amortized. It's a fixed payment, and that payment is the payment, and it is every month or every quarter. With the equity, you can set a lower preferred rate of return with your equity members. Like maybe they're okay getting 4% cash flow over the life of the project because they're going to get depreciation, and maybe that depreciation equates to an 8% return on top of the 4, and that gets them to 12. And then there's a back end equity piece that they get, and it jumps them to 20, like a 20% IRR. So that's the way to do it. It helps you on the cash flow. It helps you manage that asset while you're working on it and while you have it in your portfolio, and it gives them a benefit. They get some money, they also get a tax benefit, and then they get a back end benefit.
And it also allows you to one thing we always do, incentives are super important.
Mm-hmm.
You want incentives to be 100% aligned. What we typically do is, we waterfall the equity. In other words, so like out of the gate, our investor would have we did one where our investor had 99% of the equity until we performed. Mm-hmm. We have no problem with that because we knew we were going to perform, and then they're protected in case something goes wrong. And I think that makes a lot of sense. And we're more than happy to do that. Of course, once a threshold is met, well, then the equity changes, but everyone's made their money at that point.
And so anyone out there syndicating deals right now where you're an LP, is your GP willing to give you 99% of the equity until they perform? If they don't, maybe you should visit elevatecapitalgroup.com.
Appreciate it.
And keep in mind too, multifamily is about as recession resistant as you can find. It's residential. In any economy, again, you need two things: food and shelter. And
the foreclosure rate for B and C multifamily in peak financial crisis 2009 was less than 1%. I mean,
That's
it's about as good as it.
People need a place to live.
Nothing is perfect, but
Yeah.
Multifamily real estate's pretty resilient
1%. You'll play those all the time.
all day long.
Just like the base.
Exactly.
Yeah.
All right, folks. Thank you for joining us on the Real Estate Investor Show. We are Carolina Capital Management lenders in the Southeast for professional real estate peoples. If you have a project you'd like us to take a look at, go to carolinahardmoney.com. Click on the Plan Now tab. If you are a passive investor looking for passive returns, go to the Accredited Investor tab. This is a great show. Thanks again, Hunter, for being our guest today. And we will see you next week. Thanks.